10 growth stocks for 2019. That's what we're talking about here today, guys. Welcome in. If you're new here, I am Jeremy. This is a financial education channel. Today we're going to talk about 10 growth stocks for 2019. 10 businesses that their fundamentals underlying are phenomenal and they should grow well into 2019. We'll look at their actual growth rates. We'll look at their PEs and things like that. These are 10 very different companies. Some of them I own, some of them I don't own. I didn't want to just put all companies I own in the list. I want to include some that I don't own at all, don't have any shares in. I also want to include some international companies. So a lot of these are US based, but some are actually international companies. So I hope you guys enjoy this. As always, I know you guys love these type of videos. Hit a thumbs up if you do. By the way, if you want to join my private stock market membership group, that's linked down there in the description. If you are interested, you can check out that. All right, guys, let's get into this. The first one up here is Alibaba, ticker symbol BABA. All right, about $152 a share as of right now. Alibaba is. If you want to pause it, you can read about Alibaba's business model. This is probably one of the ones that probably isn't known as much out there by most people who aren't involved with the stock market. So if you want to pause it, you can read more about the company there. Alibaba is looking like in 2019, this company should grow revenues by over 50%, guys. This is a massive company already and expected to grow revenues by over 50% in 2019. Also expected to take the EPS up as well. They're not focusing on earnings per share yet growth, but they're still expected to grow earnings per share in this upcoming year. Alibaba's in a mode right now where they're growing revenues so fast that they're mainly just funneling money into other growth opportunities, employee counts and things like that, all right? Now, if we look at Alibaba, you would think you have to pay like a ridiculously high, forward P on this company, but you don't. On Alibaba right now, it's at a 22, which is very low for a company that's growing revenues 50+%. And even if we're looking out toward 2020, right, which is 2 years from now, then even 2020, they're still expected to grow between 35 and 40% in 2020. So needless to say, like Alibaba's an attractive company, not just because all the growth levers, not just because of a great management team, but also because the valuation is much lower than you would expect to pay for a company that's growing revenues at the rate that Alibaba is. So I love that company. That's one of the ones I actually personally own. Getting into stock number 2 of the 10 is Google. Google McDougal. All you guys probably know Google. If you didn't know, you're watching this on YouTube right now. And by the way, Google also owns YouTube. This is number 2 stock. They're over $1,000 a share, so it's not the cheapest share to buy, obviously. So Google, their business model is still growing phenomenally. After all these years of growth, they're still growing very rapidly. They're expected to grow just under 20% in 2019 as far as their revenues go. That's a very fast clip for a company that's on the scale that Google is now. They're expected to grow earnings per share very nice as well, from around a little under $42 this year to over $47 a share next year, all right? And I would say Google, as far as its P ratio, I would say it's like a fair P ratio. You're paying about a 22 forward PE, in my personal opinion, for a company like Google with the size it is, with kind of the safety of the business model there, and still the growth. Like a 22 is pretty fair for that type of business model. Google might be a share I buy at some point in 2019. We'll just have to see. Love that company. Owned in the past. Might own it in the future. All right. This next one, number 3. You know I own this one. Tesla. This one comes in at number 3 here. Right now, shares are about $367 a share. Just about 2 months ago, you could have got shares for about $260 a share. So it's gone up quite substantially over the last couple months. But needless to say, the growth is phenomenal with this company. So in 2019, they're only expected to grow revenues at around a 38% clip. One, that might be a little shy. They might actually grow more than that. 2, they don't have any big launch of a vehicle coming in 2019, at least as of we know. They're expected to launch Model Y in 2020. That should be their next major ramp and growth vector for the company as far as revenues and whatnot go. As far as the earnings per share, a massive difference. So from this year, they're expected to lose around $1.52, but now they're expected to bring in about $6.51 in this upcoming year as far as earnings per share. So you go from taking losses to now actually making profits. That's a great thing for the company. And if we look here, you might say the forward P is rich, okay, at a 50, nearly a 57 forward P on this company. But then when you look at the market cap, you're looking at a $63 billion market cap on Tesla. And when you look at the growth opportunities for Tesla stock over the next, let's say, 5 to 10 years, there's so much growth for this company in not only the auto business, because they should be the leader in electric automobiles, right? Not just that, but then you look at what energy products should do, solar roofs, power storage and whatnot in the future, and any other products that Tesla will disrupt in the future. And you look at all that and you say a $63 billion market market cap is a very small market cap for the type of growth this company has and the type of scale this company's getting to and the type of visionary management team they have there as far as being able to disrupt industries. So when you look at Tesla, it might seem rich, but then you start kind of figuring out how much growth this company has going forward, and you're looking at a 56 forward P, and you're like, that's actually not very high because of this growth. This company has an unlimited amount of growth for like the next 5 to 10 years. All right, let's get into stock number 4. Stock number 4 is another company I do not own. This one is Amazon. Okay, Amazing's. This one's a hefty price you got to pay for those shares. Okay, $1,643 just to buy one share of Amazon. So this is a business model still growing very rapidly, expected to grow well over 20% in 2019. Earnings per share expected to go up quite dramatically. This year they're expected to do around $19.79. This upcoming year they're expected to do just under $27 of earnings per share. So a very nice increase there as far as earnings per share and revenue goes. Now with Amazon, I'm not the biggest fan of the valuation of Amazon, even though it's come down quite substantially. It's still not undervalued by any stretch of imagination. When you look at this, you're paying a 61 forward P. The market cap on this company is already $803 billion. So when I look at Amazon, although it's come down quite a bit, I'm looking at the valuation. I'm not the biggest fan of the valuation still in Amazon, but needless to say, like, there's still a growth beast. They're still growing the retail side of their business in a massive way. They're still growing Amazon Web Services, which has really become a cash cow for the business now, and that should continue to grow for a long time in the future. So obviously Amazon's a great growth stock. I'm just not the biggest fan personally of its valuation. All right, and number 5 is another stock that I'm still, even though it's fallen a lot, I'm still not the biggest fan of the valuation, but it is a growth beast. Okay, that is Netflix, ticker symbol NFLX. Netflix, about $265 a share. As far as Netflix goes, expected to still grow by about 25 to 26% revenues in this upcoming year in 2019. All right, for a stock that has grown the way they are, to still be growing 25-26%, that's phenomenal. Right? If we look at the earnings per share growth, expected to go from around $2.66 this past year to in 2019, the stock is expected to do about $4.17. That's phenomenal growth in earnings per share. That's one of the strongest earnings per share growth on this list. All right. Now, another stock, I'm not a big fan of the valuation on this company. Okay. Forward P of 63 right now on this company. Netflix was a stock that was just a few months ago was priced over $400 a share. I think it was about 6 months ago or so. Netflix was over $400 a share. It's fallen so substantially, but still, even when I look at the valuation now, I'm still not a huge fan of it, but we got to still respect it. It's still a phenomenal growth company. I just think it needs to come down as far as valuation. I would have no trouble buying Netflix if it was at something like a forward P of 30 or maybe 40 range. I would have no problem paying that type of price, but with all the competition coming in their space, a 63 forward PE is just too rich for that company in my particular opinion. Okay, coming in at number 6 is JD.com, Chinese company here, just under $21 a share for JD. Huge retail business out of China. All right, this year in 2019 they're expected to grow around 20% revenues. As far as earnings per share, that might be the most impressive thing. Expected to do nearly over a double up in terms of earnings per share from around 25 cents this past year to around 57 cents. Now, JD.com, for reference, has missed, as far as EPS goes, many quarters in the past. So I wouldn't get too excited about the huge increase there because we still got to see them prove that they can hit these type of numbers. All right, JD is at a 36 PE. I say forward P. In my opinion, JD.com is one of the most disrespected stocks in the stock market. It does have some trust issues because they missed EPS so many times in the past, and also trust issues with the CEO there and whatnot. But and also it's a Chinese company, and Chinese companies just have kind of like a negative, view on them from a lot of U.S. investors. So JD.com is one of the most disrespected stocks I can find in the stock market. When I look at this company, it should be valued much higher than it is because they're just funneling all their money back into growing the business right now. Their profitability should explode when they stop focusing on so much just spending and they start focusing on profits more. But needless to say, that's a great company at a very undervalued price in my personal opinion. All right, coming in at number 7 is a stock I've been buying heavy the last few months, and that is Facebook. I plan to probably continue to buy this one throughout 2019, especially if it's under $160 a share. As of right now, Facebook shares are around $142. All right, if we look at Facebook stock here, they're expected to grow revenues by about 24.5% in 2019. That's amazing growth. You would think the way this company's valued that they have no growth growth going forward. And by the way, I wouldn't be surprised if they beat those numbers, okay? The 24.5% growth, I would not be surprised if they actually beat those numbers. Now, when you look at EPS, you say, oh my gosh, that's horrible. Like they have revenues going up nearly 25% expected, but earnings per share is going to hardly go up at all right? When you look at this company, obviously, if you're just basing off of looking at numbers and not what's going on underlying with the business, you're going to judge it in a negative light. And at a forward P of 19, some people might say, oh man, for a company that's not growing, maybe it shouldn't even have a forward P of that as far as earnings per share, right? In my personal opinion, one, I think they'll do better earnings per share than that. I think they kind of sandbag numbers. Two, this is the last year, or supposed to be the last year of the massive spend. So basically Facebook, 2017, 2018, and 2019 are the massive spend years for this company. They got too far behind as far as adding employees. We know a lot of situations happen with Facebook, a lot of negative publicity in the media and whatnot. They didn't have enough manpower hired up, okay? They didn't have enough of the artificial intelligence systems built up to cipher some of this stuff, and they just got behind on things. So 2017, 2018, and 2019 are massive years of investment, and then it's supposed to tone down to more normal levels. So in 2019, yeah, earnings per share is not going to go up nearly as fast likely as revenues, but watch for 2020 and past when the spending slows down and the revenues keep going, all of a sudden all that money starts to hit straight down on the bottom line. So it might look like it's not a great deal here, but when you start thinking about this down the road, when spending is supposed to slow in a massive way in 2020, all of a sudden the profits are going to explode again for this company like they did in the past. So that's why I love this company. I think it's a growth beast. It will continue to be a growth beast, all right? Coming in at number 8, another Chinese company up here is Baidu. This one is kind of known as the Google of China. A lot of people like to characterize it as that. Baidu, ticker symbol BIDU. Baidu trades at around $176 a share as of right now. It's pretty close to its 52-week low. As far as the revenue goes, they're expected to grow revenues by about 16.4% in this upcoming year in 2019. And as far as earnings per share, they're expected to do about $10.70 of earnings per share from $9.73 this past year. Now, I have no clue what Yahoo Finance is doing here, but like I said, analysts are expected the company to be much more profitable. So the fact that they have the trailing P below the forward P makes pretty much no sense. But needless to say, it's still a very low PE stock when you look at it, and when you look at how much growth this company has, still going forward nowadays and whatnot, and how many growth vectors they should have in the future, it definitely looks like a very undervalued company. All right. Number 9 is Shake Shack. Some of you guys have eaten at a Shake Shack before. It's a burger place. I guess you can call it a little bit of a higher end burger place. Shares right now are about $46.71. All right, ticker symbol SHAK. And as far as Shake Shack goes, they're expected to grow revenues in 2019 by about 27%. So one of the fastest growing restaurant stocks you can possibly find in the entire stock market. As far as year ago, earnings per share, they did about 68 cents. Expected to do about 73 cents in this upcoming year. So not a big growth there, but they're spending so much money on adding more and more restaurants and more employees, things like that. That's big costs that's eating up into the profits. All right. And as far as Shake Shack goes, that valuation is a little bit crazy as far as at least a forward P. You're looking at around a 64 forward P for an upscale, burger place, basically. That's rich. But then you look at the market cap and it's only about $1.7 billion. So some people look at this and they say, well, Shake Shack will be a company that will be worth $10 billion or $20 billion someday, as long as they keep executing and growing. So maybe it's not that high, but man, it's hard to pay up a 64 forward P for an upscale burger joint, okay? I can't do it personally, but maybe you can. Needless to say, it's a growth beast, all right? Coming in as a last one, number 10 is a stock I own. This one's called Callaway Golf Company, ticker symbol Eli, and it's not just a golf company now, they're actually an apparel company as well. They own several apparel businesses. Now, it's a tricky one. So if you look at the revenue as far as what analysts are expecting is on Yahoo Finance, it says only 3.6%, but that's a trick, okay? First off, they just announced they're going to acquire a company named Jack Wolfskin, which does around nearly $400 million in revenue. So that's going to be a massive boost to revenues. That will push revenue growth up probably 30% plus in next year. Then on top of that, you have a Topgolf investment there, which isn't seen on any of the numbers. It's on the balance sheet, but it's not seen on any of the numbers as Topgolf continues to grow. grow, guess what else grows? Callaway's investment in Topgolf grows from an investment that used to be like worth 40 million to now it's supposed to be worth 400 million. As Topgolf continues to expand around the world, that investment becomes worth more and more and more. And whenever Callaway wants to sell that, someday down the road, they can sell that for a massive profit. All right. So needless to say, it's going to be a nice growth year. As far as earnings per share, we're not sure about that because we're not sure what all the costs will be. But right now it's at around under a forward P of 15. Like I said, we're not sure about where everything will shake out there because whenever a company acquires another company, sometimes you have a lot of costs in there that ends up eating into some of the profits in the short term for a quarter or two, and then things bounce back. So needless to say, those are 10 great growth companies for 2019 and moving forward. I would love to hear from you guys if you've researched any of these or if you're going to research any of these. Let me know in that comment section. Hit a thumbs up if you enjoyed today. As always, if you want to get in my private stock market membership group, that should be linked down there in the description. Thank you for watching and have a great day.